Creative financial engineering is nothing new to the market. In 2019, we saw PetSmart and J.Crew engage in controversial asset strips. But now it feels like more and more companies are employing divisive measures such as priming, up-tiering, and financing through an unrestricted subsidiary. Why are companies pursuing these types of transactions? And will we see more lender-on-lender conflicts to come? Everyone wants this question.
I'm happy to start. Look, I think we're going to continue to see more of this, and I think it's unsurprising. I think companies are going to do everything in their power to generate as much liquidity as they can or look for any little window to extend runways. And I think if you go back 20 years, whether you look at holdco PIK notes or you look at stripping of assets, or you look at unsub transactions, I think people are going to be as creative as possible and are going to find new ways to try to generate more liquidity. I think if you're I think back to when I was a CEO of a variety of businesses, it's your job to provide as long a runway and as much optionality to let your business perform. And so I think you're going to keep seeing more of these.
Yeah, I mean, if you delve into the macro factors behind some of these more creative financings, as I like to call them, Paul mentioned this in his remarks. Obviously, the rate environment today is pretty different from what we saw over the last 2 years. We've had a fairly benign, capital markets, quite frankly, over the last decade plus, right, post the GFC. And so when you think about companies that are borrowing on floating rate debt that were used to a very low, near zero rate environment to today going to, over 5% on 3-month SOFR, that's a pretty big change. Pre-GFC, I was at Citi in the sponsor coverage group, and there was a time when, not only do we have covenants in financing packages, banks used to also require borrowers to hedge their floating rate debt. Right? And where has that gone? That's gone the way of covenants. So borrowing costs are up. You've heard, prior remarks about the massive amount of inflation we've seen in the supply chain, not only on the raw material side, but quite frankly on the labor side, both in terms of labor shortage. And really that will impact companies, your widget manufacturer, your industrial company to, healthcare services companies that are employing more skilled labor. That labor shortage causes wage inflation, right? That squeezes your margins. And the amount of labor turnover and the inability to retain your labor force, that's all incremental costs. And depending on where the company is in the value chain, they may or may not be able to pass that through. There was a lot of discussion around stress in the healthcare services sector. Part of the reason we're seeing that is because when you have a government payer, whether it be Medicare or Medicaid, the government is setting your rates. This could be at the state level, this could be at the federal level. And usually those happen on the lag, right? So they'll look at, prior 2 to 3 years inflation indicators. And so, yes, those rates are increasing, but they are not increasing at a fast enough pace to compensate for the increase in labor costs. So a lot of those macro kind of stress factors are pushing companies to utilize more creative financings. When your first lien bank debt is trading in the 60s or 70s, with a low to kind of mid-teens yield to maturity, it gets really expensive to try to raise pari new first lien money, right? Maybe almost impossible. A lot of the big banks have taken quite a rough few months, right? Syndicated markets, I think, are slowly starting to come back, but you really, as a borrower, have to check all those boxes to get a warm reception in the broadly syndicated markets. And so, all of that I think is really causing borrowers to look at more creative ways to work within the confines of their credit documents, but to come to capital providers, like a Centerbridge, like a King Street, to talk about these types of asset drop-down financings.
Yeah, I think it's a good point that from the borrower perspective, it is driven by a higher cost of capital. And in order to make a new financing transaction achievable based on where rates are, based on where a distressed company's debt is, they're going to have to do some sort of transaction where that effectively takes value from one group, whether it's a minority lender or the restricted group of creditors to unrestricted subsidiaries and sort of move that around such that, new financing at par makes sense. And so in some ways, the borrowers themselves are a victim of circumstance, and then these creative structures are being driven either by the sponsor, existing majority lender groups, or then maybe opportunistic credit funds. But at bottom, it really is being driven by lack of new money financing at par, without sort of rearranging the existing structure.
But what
Just one thing on that, and I think you guys both bring up a great point. I mean, I simplify it as it used to be really easy to raise money, and now it's a lot harder. And so you have to get much more creative. It used to just be really easy.
Yeah, the irony is I think the creditor-on-creditor violence transactions sort of evolved from low rates and creditors trying to realize value because they weren't, the cost of capital was so low, right? So they were essentially getting a higher economic recovery from lenders within the facility or other lenders, within the broader structure. Now it's almost reversed where they're trying to strip value from other constituents because there's just very limited value to go around and they don't have other financing, regular way financing.
But what has really been achieved by these transactions, since quite a few of the companies that employed these type of deals, a couple years ago, last year, are now in trouble again and have to restructure?
Yeah, I mean, companies undertake these types of financings to buy runway, right? It solves a portion of their issue, which is, the right side of the balance sheet. So, this could be new money financings combined with liability management. So, maybe you manage to capture some discount in any sort of up-tiering or exchange. So you're really fixing half of your issue, which is the liability or the liquidity side. It gives you runway to try to solve the other side of the balance sheet, i.e. the asset and the operations, right? A lot of companies that resort to this type of financing are maybe facing secular pressures. And so sometimes they can solve the issues in the amount of time that they bought, and sometimes they can't. And then there has to be a broader restructuring, whether in court or out of court, to reset that cap stack, so to speak. But look, I think it is hard to dispute, in types of transactions that bring in a lot of new capital. There is additional runway and optionality being created for the company. It's just a question of whether or not it's enough.
Yeah, I think it's a great point, and I think they're two distinctly separate pieces. One is trying to fix the company and improve earnings and grow into your capital structure, and the other is trying to buy as much time as you possibly can. And I think as management, as long as you're solvent, you're supposed to do everything in your power to try to extend that runway. And the fact that many of them haven't been successful, while true, I'm not sure is a fair way to look at the activity. The activity is still give yourself the best option. And for the 1 in 50 or 1 in 40 or 1 in 30 where it's worked out, that's fantastic for equity.
Yeah, I think from a board perspective, right, the right answer can't be we're running out of money, so let's not explore new financing opportunities either with third parties or our existing creditor base. That being said, when you do have a company that has gone through liability management transactions, there is a cost to that. So for example, I think one of the costs is just by way of a more complicated structure, right? You have now potentially, let's take a drop-down financing transaction. You went from maybe collateral and assets sitting in the same subsidiary boxes with the same group of creditors to now having potentially one set of creditors at one box and another group of creditors at another box. And now you've presented a whole host of bankruptcy-related issues that could increase the cost of the Chapter 11 case, increase potential board liability, and also risk to the participating creditor base. So these transactions absolutely extend runway and optionality, but they don't come at a cost just from a process standpoint.
I'll just add one thing to that. There's also a massive management distraction now. Instead of focusing on improving the business and fixing your operating problems, Now you have different creditor groups. Now you're getting potentially sued. You have angry lenders. You have a whole new world of things to deal with that are not just trying to fix the company. Doesn't mean you shouldn't try to still get the liquidity, but you also add those costs.
So at what point do you recommend to a company that they should do a creative financial engineering proposal? Is it kind of a last resort, or, and that's for you as the advisor?
No, sure. I mean, look, you're balancing all of the costs that you mentioned. You're balancing the distraction, and then you're balancing the delta between what you would get from the more complex transaction versus what you would get from the easy transaction. And you're really weighing those two against each other. So if I'm going to get 5 times the amount of liquidity from the more complex transaction, but I have distraction costs and some other costs, I'll do it. If it's 5% more liquidity, I won't do it. And an individual circumstance will dictate which one you pick.
Yeah, I think a key issue, right, is being able to establish a go-forward plan such that if you execute on that plan, you will actually be able to avoid liability, right? Avoid a Chapter 11 or some other downside scenario. And that, just from a mitigating board liability, is one of the things that's going to be look like if you are unsuccessful and in a Chapter 11, right? You may have a creditors committee look at the financing transactions. One thing to note is, in these financing transactions, particularly if you're increasing the leverage, right? Trade creditors may view that, although you're extended the company's runway, if you also extended the company's leverage and increase their liabilities and really have nothing to show for it, right? That to them is not something that, they're going to say, well, you tried, thank you. No, they're going to look at that, and that could give rise to, breach of fiduciary duty claim or something to that extent. So I think it's the key. One of the keys is to have a business plan that makes sense and in the context of the liability management transactions, that shows a path toward reorganization, a path toward growing into your capital structure, rather than just sort of raising new money and hoping.
Well, are we seeing a dynamic where hedge funds are pitted against CLOs? And how are CLOs protecting themselves? And we've seen kind of this growth of cooperation agreements. Do those work?
Yep, I'll take the first one. So look, there certainly is an element of a new lender, right, that may not have an existing position. So your hedge funds in your example, versus the CLOs, right, who are managing a portfolio of a couple hundred positions, and this just happens to be the one that has gone into trouble. So there is sort of a new versus existing lender kind of potential conflict there. It's interesting. I mean, we participated in a fairly well publicized financing for a company in the healthcare services space, early last year. And there was a fairly large, over $1 billion new money component of that, coupled with an exchange by existing lenders, right, into the box where, where certain of the assets were dropped. And we actually saw, an existing lender participate in both the new money financing component of that, as well as the exchange component. And it really came out of, different funds that had the flexibility to do the new money, and then their CLOs participated in the exchange. We also have a performing credit part of Centerbridge. We have CLOs and CBOs. What's interesting within sort of the CLO universe is really, as a response, right, to these types of creative financings kind of becoming, I wouldn't say mainstream, but we're seeing them more often. We are seeing CLOs kind of get more sophisticated about, what they can and can't do. The old school CLO style of thinking is, look, I'm really, first of all, I'm a levered vehicle, right? And my investors are really paying me to focus on the performing credit side of my business. And if I see trouble, coming down the pike, let me get out of the way, right? Let me sell. we are seeing, CLOs, are certainly, especially the ones with sort of post-2019 kind of vintage, debt documents, kind of start to build in the flexibility, with their own lenders to allow them to participate in new monies. So, look, do we still expect, sort of more opportunistic type of capital to really take the lead around the new financings? Absolutely. But do we think CLOs are kind of evolving, to play a more, defensive or offensive, kind of however you want to see it, position? Yeah, we're definitely seeing that as well.
Yeah, I mean, I view it more as size, right? I think CLOs are more likely to be in a smaller size and therefore be in a position to be on the wrong side of a liability management transaction. In fact, anecdotally, I've talked with some hedge funds, and they are a little bit skittish about taking small positions in distressed situations in the expectation that there will be some sort of potentially, majority-driven liability management transaction that strips value from minority lenders, or at least primes minority lenders. And so I think, to me, it's more about who's more likely to be sizable in a name. And I think the CLOs are more likely than not to be of small size.
We're seeing a number of...
Just on the cooperation agreement, because I actually wrote an article on cooperation agreements in King & Spalding's Hub. Just give a little shout out to that. I think cooperation agreements work. They're pretty straightforward, right? I think the issue is whether they're appropriate because they're locking up lenders and reducing their ability to get out of a name until a certain event happens, whether that's a litigation decision, an outside date. And so I think it's whether it makes sense to go the cooperation agreement route based on the risks of not doing so, and then the costs, namely being locked into not being able to sell or only being able to sell to a third party subject to the cooperation agreement. And so to me, that's sort of the interplay there.
And also, on the co-op, I mean, importantly, the co-ops are typically they're for existing lenders, right? They're usually existing lenders kind of hooking arm and saying, look, if we do anything, we're going to do it together as a group, right? We're not going to do, up-tiering or priming transactions that kind of, mess with each other. What it doesn't restrict is a new lender's ability, right, to come to the table and do a new money financing kind of along the lines that we just talked about. And so that, there certainly is that. There certainly is, I think, that factor there as well.
We're seeing a number of these creditor-on-creditor cases make their way to courts as minority lenders are looking to claw back these transactions. We really don't have, though, is case law supporting or negating these deals. Although a bankruptcy judge in Serta Simmons gave his blessing to open market purchases. How are companies, lenders, and advisors sizing up these cases?
So I can take that one. I think it's just very fact-specific. I think in the context of a Chapter 11, right, from the minority lender standpoint, if you already have an existing litigation, right, then that's one thing. But oftentimes you may be a minority lender and you haven't brought in a litigation, or maybe the Chapter 11 itself is presenting a majority versus minority issue. And I think, you really have to be focused on the cost-benefit analysis and also appreciate the forum of the Chapter 11 case and whether the court is going to be incentivized or be drowned out by other stakeholders and their interests that the court views as more significant, because from the court standpoint, the number one goal is to have the company reorganize in a cost-effective, quick way, right? And intercreditor litigation can sort of undermine that goal, right? And so I think one thing to look at is the forum going to be relatively friendly, or are other stakeholders going to sort of be aligned with the company and the majority lender group and sort of flush what could otherwise be a very meritorious litigation. You also have to look at the economics, right? If you're doing a breach of contract claim and a damage claim against a debtor in bankruptcy is probably not going to be worth 100 cents on the dollar. And there are ways to for the borrower and the majority lender group to essentially flush a litigation claim, or at least reduce the expectation of recovery, even if you prevail. On the majority lender group side, I think you have to weigh, what a settlement could look like, and also the cost of litigation, because the fulcrum lenders, right, are often the ones paying for the litigation, and that payment is in cash dollars to professional advisors, right? It's not in take back debt or reorganized equity. It's in 100-cent dollars, and it can be a real cost, right? Take the 9 West bankruptcy, which I was involved in, and there was a lot of intercreditor litigation there, and the total professional fees were, I think, in excess of $150 million. That was a real reduction in recovery to the lenders, and so I think you have to balance the majority group's interest in their economic recoveries against the cost of litigation, which can be real, and then also the reasonable expectation of the plaintiff group, right? Are they looking for something that is out of the realm of what is a reasonable settlement, or are they just looking to save face and get some sort of recovery? So again, very facts and circumstances specific, but there I think once you're in Chapter 11, it complicates the already complicated dynamic of intercreditor litigation.
Well, do you think these deals, though, are kind of a breach of good faith when not every lender can participate?
I'll take that quickly. So, short answer is no.
No, there we go.
So first off,
No,
because
we're good.
I could never say yes, because that would foreclose a huge area of my practice. But so first off, just to put a finer point, I think Reshmi is alluding to this New York cause of action, breach of implied covenant of good faith and fair dealing, which you see in a lot of these up-tier transactions, where it's sort of a separate claim from breach of contract, essentially alleging that the parties use a discretionary term of the contract, really their required lender power to amend the credit agreement in a way that destroyed the parties' benefits of the bargain, the fruits of the contract. And to me, I view it kind of as like a spectrum of like the reasonable expectations of the parties in amending a contract, right? So one example in board riders, a case that I'm involved in, is covenant stripping, right? To me, there's a reasonable expectation to strip covenants in the context of a consent, some sort of consent transaction where everyone has the opportunity to participate, and to incentivize participation, you say if you don't participate, you are going to be left with a piece of paper without any covenants, right? This is something that's been done in the bond market for many years. It's, I think, more recently done in the credit market in the context of amendments. And I think every lender should have an expectation that in the context of some sort of all-lender consent, right, that is a risk. In board riders, however, the majority lender group and the company strip covenants for no reason other than essentially to weaken the minority lender's position, and there was no consent solicitation. They just did it because they could, and then they exited out of the paper as soon as they exchanged into a super priority facility, as soon as they effectuated the amendment, right? So they didn't have to live with the amended credit agreement. So to me, on the spectrum, right, that sort of sounds more in the breach of implied covenant of good faith and fair dealing facts than a traditional sort of stripping of covenants to incentivize participation offered to all parties.
Well, we're saved by the clock, or you're saved by the clock, but just wanted to get a quick answer from you. Do you think it's a breach?
I think it's fact specific.
Okay. And that's all the time we have. And I just want to thank our fantastic speakers. And you did a great job. And please look out for our future Bloomberg events. And we'll see you again at Brink Live 2024.